practicing law since 1999. I make my home in Orange County, and my practice is in Santa Ana in Orange County as well. I serve clients throughout Southern California, Los Angeles County, Orange County, Riverside, San Bernardino, San Diego counties, and my focus is in the areas of estate planning, asset protection planning, business law, and the formation of corporate entities and corporate real estate and transactional law. So a lot of what Sensei does, we work well together as far as working with his clients, working with our clients, and so we get together several times throughout the year and discuss our practice and how we can help his students, and go over our strategies, and obviously help you with your questions and all of your investment strategies. So tonight we're going to talk about asset protection planning and helping people protect their wealth, protect their estates, and make sure that they hold on to it to pass it on to the next generations and the next generations to come.
I would say we got a pretty good, I mean, I know a good fair amount of you, and I would say we have a pretty good mixture of different levels of investors and entrepreneurs in here. Some of you in here are buying and holding properties. Some of you in here actually buying, fixing, and flipping properties. Some of you are starting a real estate business on the wholesale side, and some of you have no idea why you're here, right? So, but we're going to touch on everything tonight, and Matthew being the core of everything, because this is his field of expertise. And I'll tell you, we've been working together for about 7-8 years now, right? And so we're in communication quite a bit, not on the client side with my clients to him, but with my own stuff, going back and forth and helping out. And I've helped him out a little bit with his clients for real estate. But one thing I can say is that every time he's come to a club meeting and spoken to the audience, I'm constantly learning something new. And it's a world that I think if I wasn't a real estate investor, I'd probably be stepping into this world, but I'm not smart enough to be an attorney, so that's why I'm on this side over here. But again, if you guys have questions, you're more welcome to ask, but we're going to be touching on a whole lot of stuff. And if you're going way off on that direction, I'm probably going to rope you in and pull you right back in, because we're eventually going to get there. So let's start. Let's take this. We've got investors in here that are just starting a business, and they're wondering, well, should I open up an LLC for my business? Should I open up an S corporation? Should I do a C corporation? Should I do it in-state or out-of-state? But raise your hand if you're a wholesaler or a rehabber in here. Wholesaler, rehabber, come on, we need help here, okay? So we've got about maybe a third of the people in here that are wholesaling and rehabbing properties. With that, where should they start? Should they do it as a sole proprietor, or should they get going into an entity?
Well, once you've made the decision to do this as a business and actively participate in getting involved in deals, then you're no longer treating this as a hobby, you're treating it as a business. So you want to incorporate yourself and your business so that you'll gain credibility with all the people and parties that you're dealing with. You'll also want to get some tax advantages by setting up a corporation. Lastly, you want to protect yourself personally, your personal assets, in the event that your business gets involved in a lawsuit or gets sued. So you want to protect your personal assets and get those assets away from a potential liability if one of your business deals goes south. You want to let your people and vendors know that you are a legitimate business by setting up a corporation or having the word Inc. or incorporated behind your company name. Just tells those out there that you're doing business with that you are a serious company. You're not working out of the trunk of your car or your garage. You're legitimate bricks and mortar type of business. And on the tax perspective, you'll get tax advantages by incorporating your company. You will get a reduction in your self-employment taxes by becoming a corporation versus a sole proprietor. So you will gain many advantages by incorporating your company versus just being a sole proprietor.
So if they're going to incorporate as a wholesaler or be in the real estate business of buying and selling, do you recommend the LLC, you recommend the subchapter S, or the C corporation, the partnership? Which direction do you think they should go in?
So for wholesaling and flipping, buying and then selling, those are very quick transactions, and so you're going to see gross receipts coming in on each deal, and they're going to be large amounts, even though your net profits may not be as much because you have carrying costs, you may have purchase costs, rehab costs, and whatnot. But at the end of the day, you'll have a gross sales amount, which will be rather high, depending on how many transactions you do. So in California, if you're a LLC or limited liability company, there's a additional gross receipts tax that's attributed to LLCs in that type of business transaction. If you're a California corporation or a subchapter S corporation, you avoid that gross receipts tax, so you will not have that extra additional tax if you do that type of transaction under the entity of a S corporation.
So, does that also apply to someone like Mary Lou that's a realtor? I mean, she's not out there, you're not out there flipping properties, right? You're just helping clients and buying and listing properties and helping them buy properties. I mean, most of our real estate agents out there are just sole proprietors, right? Is it advantageous to them to become?
Absolutely. As an active business owner, you hold a license to sell real estate, and in California recognizes professional corporations and companies that the owners that hold a license, such as a real estate broker's license or a CPA, accountant, an attorney, and those individuals that hold those types of licenses are allowed to be corporations. They're not allowed to be LLCs because California does not have legislation that allows an LLC to be a professional entity. So for a person running a business, such as real estate, you would hold your license through that S corporation, as well as get that tax benefit of reduction of your self-employment taxes by way of being a corporation versus a sole proprietor.
So we have a subchapter S corporation, and then we have the C corporation. Can you tell us a little bit about the pros and cons between the two?
Sure. Every corporation that's formed initially is considered a C corporation. It has a double taxation effect on earnings as well as dividends or distributions to the shareholders. An S corporation doesn't have that similar taxation effect. The S corporation will tax the shareholders upon their distribution and receipts after expenses are paid out, and overhead, which would include your rent, your advertising, your utilities, your payroll, any expenses that get involved with the running of that business are expensed out first, and then your net profit, which is at the end, which gets paid out to the overall owner of the company, will be taxed at that own individual personal tax bracket that they are in. So the corporation, for an S corporation, pays no federal tax. It has no federal tax liability. The taxes will pass through to the individual owners after expenses are netted out.
What does that exactly mean, pass through and netted out?
Well, the pass-through is if the corporation has a gross receipt of $1 million, and at the end of the year, after it's paid out all of its rent, overhead expenses, utilities, office supplies, payroll, it may show a profit of $100,000. And so that net profit passes through the company. The company pays zero tax if you are an S corporation on that net profit, and then it gets applied to you via either a K-1 or a W-2, and then you as the individual owner will pay the tax on that income that actually passed through the company to you personally. So you're saving in taxes in that you write off your legitimate business expenses, and then you pay your taxes to the IRS at the end of the year when April 15th comes around.
How does that filtration system with a passive entity differ from being a sole proprietor?
Sole proprietor, you're going to pay self-employment taxes, usually around 15 to 16%. So which means that for every dollar that you earn, if you, for instance, earn $100,000 in profit, you'll right off the bat $16,000 in self-employment taxes. Once you become a corporation, that self-employment tax gets cut in half, because no longer are you paying withholding on the employee and the employer side. As a corporation, you just withhold on the employee side because you're considered an employee of the corporation. So that 16% goes to about 7.5%. So you, on $100,000 a year, you would save close to $8,000 in self-employment taxes just by incorporating yourself.
That's powerful, because you know, in real estate, you can easily make $100,000 a year, you know, flipping properties. And I come across a lot of investors, you know, consulting with them, and they are hesitant to open up a corporation because they don't want to be stuck with this annual fee of $800 a year. And because when you open up a corporation or limited liability company in California, they have an annual fee of $800 a year, plus you got to pay $25 per year for the statements that they also have. So you're paying $825, and you're like, well, I don't want to pay for a corporation that's going to cost me, I don't know, $1,500 and then pay $800 a year. Well, I think that's not the right thinking. You know, you got to take a look at what you're really doing here. You know, one, if you're going to be flipping properties and you did bring in $100,000 and you're not a corporation, then you're easily paying out 16 grand in taxes. But if you are incorporated, you only spent $2,100, right? But you're cutting your self-employment tax in half, which is still now pulling you ahead of the game, which is really important. So to me, those people that are hesitating on doing that are usually the ones that are not serious about the business.
Absolutely, and also when you incorporate your business, many times the IRS likes to audit business owners, and sometimes they like to say the business owner is just doing this as a hobby. And so when you write off expenses for investing in real estate and you call that a business expense when you're sole proprietor, the IRS will sometimes audit you and change that expense into actual taxable income. And so when you are sole proprietor, it's more likely that they will audit you based on that theory that you're conducting a hobby and not a business. When you go and incorporate yourself, now you're filing a separate return. It's a corporate return. You're showing the IRS as well as every other entity or individual out there that you're doing business with that you're a legitimate business. You're following the rules and regulations and formalities that corporations are required to follow. You're paying that $800 a year to the Franchise Tax Board. You're keeping good books through your QuickBooks system. You're filing your tax return through your accountant each year, and you're following the business formalities that a normal corporation would. Less likely to be called or considered a hobby when you take those extra steps to incorporate yourself.
So, as a real estate investor or a real estate agent, or someone that's maybe a plumber, electrician, or got basically their home-based business, I think basically the best way for you to tackle this, should it be an S corporation, C corporation, is going with the S corporation here locally. But that brings up another point. I said locally, should we incorporate here in California, or should we be doing what all the radio ads are telling you to do and run over to Nevada or Wyoming or Delaware or something like that?
Well, general rule is if you're doing business in California, then you really need to be incorporated in the state of California, not just for tax purposes, but also for legal purposes. If you're sued in California and you are operating a Nevada corporation or a Delaware corporation outside of California that's not registered to do business, then that corporation technically cannot defend itself in court to be able to present its own case in a court of law. So you really, if you are in California doing business, you really need to choose to incorporate your business in the state of California.
When is it okay to step outside of California?
Well, that's I guess a rule or a gray area, if you may. It's I don't want to use the words disputed, but in some camps, tax advisors will say that if you're doing business outside of California and you have contacts outside of California and you have business outside of California, then you are able to incorporate a business outside of California. If you're a resident of California, ultimately any income that you earn in the United States or worldwide, you still are taxed in the state of California, but you are able to set up a business outside the state of California when you have real estate holdings, management, wholesaling, flipping, or even long-term holds outside the state.
You had a question?
Yeah, what if you're selling merchandise? What if most of your stuff is outside of the state? Like say 75%?
Yeah, again, how are you selling? Where is your manufacturing plant? Where are your headquarters? Where do you live? Where are your clients? Those are all questions that go into that formula or analysis, actually. So, I'm an attorney. I'm not a CPA. I don't prepare taxes. But what I can tell you is that the government will look at your minimum contacts, and they'll look at where you're located, where you're headquartered, and if you're in a state where you're doing business, you have your bank accounts located in that state, your customers are in that state, or your manufacturing headquarters are in that state, then they'll say you are subject to the tax rules of that particular state where you're doing business.
So on the buy and sell side of things, it sounds like the S corporation is going to be the best way for us to go, right? But what about the buy and hold side? Do we put it in the S corporation? Do we put our rentals in a C corp partnership? Where do we go with that?
So for the buy and hold or the long-term hold, where you're going to hold on to your real estate investment, you're going to have tenants come in for the long term, and you're going to receive rents. You're going to pay your mortgage for that particular piece of real estate. You're going to do your management and maintenance and repairs. You're going to want to set up a limited liability company or LLC. Those companies are more preferred type of entities for asset protection planning and also for tax planning as well for the investor that's planning on holding real estate for the long term.
Well, go ahead.
Could you explain that a little bit more?
Can you explain a little bit more?
Well, for the asset protection side, the LLC has case law and statutory law that protects the actual member or owner of that company. So the member is synonymous to a shareholder of the corporation, and the member will have the shares of the equitable owner of the company. So if the member is sued as an individual for whatever type of lawsuit, the person suing that member will not be able to reach into the LLC and seize the assets that are under ownership of that LLC. They can only get what's called a charging order against the member, and what a charging order is basically an assignment or the rights of an assignee to receive the income stream that would go to that particular member. So if that member were under attack, that member then would typically be disassociated or no longer a equitable, profitable owner of that company, and so that his share or his or her income stream would be cut off, so he would not lose that income. It would go to another partner or another family member that could own his share or be another owner of that company.
One more question. Now, if you were trying to do both things as far as own the rental income that you're going to hold long term, and also trying to flip products, would you say you should own both types of corporate?
So I think the question was if you're in the business of wholesaling and flipping, and you're also in the business of long-term holds of real estate, can you just use one company to do both businesses? I would answer that no, for several reasons. But one is you don't want to put all your eggs into one basket. One business in the wholesaling flipping side is more or less a cash flow type of business where you're going to be doing deals each month, each year, and that money is going to be coming in and out of the business. You're going to be using money to purchase new projects, new real estate investments. That type of business can be very lucrative, but at times it can also be risky because sometimes you're going to have an assignee or a buyer that you sold to or got into contract with that's not happy with the outcome of how that deal went down. So if that happens, then that business that you're running could be subject to a lawsuit, which is okay. That's just the cost of doing business in this world. But what you don't want is your long-term property, your long-term real estate investments to be a part of that corporation's asset, because if it is a large judgment award against that company, you don't want that creditor to be able to reach in and put a lien against your real estate or other long-term holds. And so you want those long-term hold assets to be in a separate entity so that they're separated, your eggs are in separate baskets, and so you cannot lose all assets with one catastrophic event.
Thank you.
So each property should be an LLC, correct?
Sometimes yes, sometimes no. It all depends on the property itself, the equity that you have in the property, the level of risk that the property poses, where the property is located. All those go into the analysis. And so when I meet with clients, I explain to them, to set up an LLC, to maintain it annually it's an expense, and it's just like any other expense, like your management expenses, your utilities, your property taxes. It's another expense that you put in to that investment, and so if you're barely making it, or you're barely showing a profit, your expense to incorporate or set that LLC up, could tip you over the edge where it's not a profitable venture. So sometimes we'll recommend maybe putting 1, 2, maybe 3 properties into one LLC. Other times we'll recommend setting up what's called a land trust, and the land trust will hold title to that particular property, and you'll have a separate LLC that will be the trustee and or beneficiary of that land trust to benefit from the tax breaks and also the profits from that real estate investment.
So then that would not be considered a single member LLC, then it would be more than one member in the LLC?
It depends. I mean, again, the LLC, there's different types. There's single member LLCs, there's partnership LLCs where you have more than one owner, and there's LLCs that are taxed as corporations. So you could hold a single member LLC that would simply act as a trustee or beneficiary of that particular land trust. But it's not required. You could have a dual member LLC that would act as the trustee.
So if you're talking about S corp, could you be an LLC that files as an S corp? Would that still be beneficial to you?
You can, absolutely. And all of these tax decisions are really conversations that you want to have with your tax advisor. Again, I'm an attorney, I don't file tax returns. I do consult on the different statuses and formations, but normally what we do is we'll sit down with the client, we'll also consult with that client's tax advisor, or we'll bring in one of our tax firms that will make that ultimate determination on how we want to tax that LLCs. But often we do choose the single member LLC, which is disregarded for tax purposes. Sometimes when you have another partner that's a non-spouse partner, we'll recommend setting it as a dual member or a multiple member LLC that's taxed as a partnership, and it files a 1065 return. So it just all depends on the situation with the investor and who's in business with that particular person.
And one final question. If you have a couple of properties under one LLC and somebody sues you, would they be able to get the other properties?
So the question was, if you have several properties under one LLC and someone sues you, so I guess my question is, are they suing you as an individual, or are they suing the LLC?
They're suing the LLC, but they're in like a renter in one of the properties.
Yeah, so again, that's a good question, and that's always something that we put into our analysis. If you have several properties under one LLC, and say that one property in that LLC is under attack, or you have a tenant in one of those properties that's seriously injured, then yes, those other properties could be at risk. And so that's why our theory is, don't put all of your eggs into one basket, because you could have one event that occurs that could eat up all the other assets in that particular business entity.
But with that, if you do have multiple properties in an LLC, you can take that extra measure and start attaching a land trust to each of those properties, right?
That's correct. That's correct. So now you're setting up separate entities, which would be a separate trust, which would hold each separate property. And the good thing about that is the trust will provide privacy of ownership because title is under the name of the trust. It's not under your own personal name. The second advantage is it's a separate legal entity. So if one property is under attack and you have 3 others in this separate trust entities, those properties would not be in harm's way. Lastly, the trust itself does not have the same annual maintenance requirements that a corporation or LLC does. So it doesn't have to file a specific tax return, nor does it have any franchise tax fees each year to the state where it's located to keep itself in good standing. But you want to have a trustee that's going to be typically a corporate entity like an LLC that can act as a trustee, that can be the management company, that can receive the rents, that can act as the manager and be able to maintain those properties.
So I'm saying rather, if you've got like say 10 properties, rather than having 10 LLCs, you can have 1 LLC and 10 land trusts.
That's right. That's the theory, and that helps our clients cut down on the legal fees to set up and cut down on their annual maintenance costs to maintain the actual companies.
And so what you're basically doing is just adding more layers to that onion there.
Yeah.
You know, it's more cost effective,
Sure.
you know, with those 10 being in there. But then again, it also depends on what you mentioned earlier. Are they 10 $50,000 houses, or are they 10 $500,000 houses? Are they in the bad neighborhoods or in the good neighborhoods? And you got to look at the other risk factors as well to see if you want to keep all 10 within that LLC or start splitting them up.
And if you you had a property, let's say like through since it's remote rehab, you get a piece of property in Cleveland, you still set that all up. The LLC would still be set up in California, land trust in California also.
Your options are open there. The land trust would definitely be the recommendation to hold title to it. If you're going to have multiple properties, I would definitely say set up the LLC. If you're in California, Governor Brown would love to have you incorporate in California and get their $800 franchise tax fee. As I said, there's different camps that believe that you could set up it outside the state of California. And we always sit down and do a complete analysis with our clients before we make that decision for them.
Did I see someone else's hand? Yes, go ahead.
Which state's land trust law do you suggest following?
Well, land trusts typically originated out of the state of Illinois, and that's where they're well known. We talked last night, apparently Arizona doesn't really have a legislation that follows land trust. I'm licensed in California, so I'm not licensed in all 50 states, so I didn't take the bar in Texas or Florida or New York. So we do have land trusts here in California, and we do set them up here for our clients that have real estate holdings here. So depending on where the holding, where the property is located, what we'll do is we'll do some research to make sure that state particularly will allow land trusts, and there's protections there in that state to have land trusts.
For California, which state does it generally follow? Because my understanding is California doesn't have specific land trust law. It just refers to Illinois or Delaware or one of the others.
Correct. So, in California, what we have is trusts. A trust itself is recognized in California. So the trusts that we prepare are very similar to living trusts. We have the same parties, such as a settlor grantor. You have a trustee and you have a beneficiary. And the purpose of the trust is to be funded by a piece of real estate. And so with that, we follow the rules of California state law with regards to trust law and holding of real estate.
To my knowledge, you can use land trusts in all 50 states, but not all 50 states are friendly with land trusts. I found, me working in multiple states across the nation, that most of them are pretty darn friendly in regards to us as an investor using a land trust. But like you mentioned earlier, we were talking about Arizona, where Arizona doesn't recognize the land trust. But I own property in Arizona. I still use the land trust over there because although it would not protect me if I were under attack, protect that one property, but it does give me the privacy issue. It does take my name out of public eye from the public recorder's office. And to me, that is worth setting up the land trust for that reason. And a couple other things. I mean, there's a lot of powers behind the land trust. It's just, like you mentioned earlier, it's just a one-time fee basically, and it's really dedicated towards privacy. You know, we've got to think about how do these big boys or how do these celebrities hide everything from the public eye, and this is the way they do it. Plus, using a land trust, like we just recently encountered that one of the cities over in the county of Cleveland says, hey, you're buying properties in an LLC. Well, you now have to register that LLC in the city, which is now a $100 a year fee. So now that owner that actually opted out from using a land trust, closed in the closed title using the LLC, taking title of that property, has to pay a $100 fee for that each year. But within that same city, if you were to close it in a trust, it is now exempt. You don't have to pay that fee. So again, there's a lot of power there in the privacy to where we can actually, you know, trade properties in a way. I don't want to say really trade, but move properties around within an entity and not have to trigger any type of sales tax or anything like that as well. Yes, sir.
Once you have properties in an LLC, can you move them to a trust?
As long as you are the manager member of that LLC and you have the authority to do so, which typically that's the way we'll set up our companies so that our clients have that full authority to transact and conduct real estate transactions. Absolutely, you can move them from one entity to the next, depending on the purpose or reason why you want to do that.
So in my, you know, and correct me if I'm wrong, but if you own a property in your own name, or you got a corporate name, or you got an LLC name, you can transfer that over into a trust as long as you're the same in one, right?
Correct.
So if you're thinking, oh, it's too late, I should have closed this in a land trust. Well, we can still move that property over into a land trust if you wish, and it does provide you that protection as mentioned earlier. However, it will show in the chain of command and title that it was actually sold to you and then you moved it over into a trust. So there, you still have that exposure there, although you did now segregate yourself from being personally liable for that.
In California, we have a neat rule, it's called a blind recording, where you can do what Sensei just described, where you can take title to that property yourself as an individual, and then you can transfer it to your LLC or corporation. And there's what the rule is as long as the grantors and the grantees are the same, and they hold the same proportionate interest in the property, you will avoid any reassessment under Prop 13, and there's no taxable event happening there. And so what you do on the face of the deed is you show that there was no transfer tax, or the transfer tax is not for public record, so the rest of the world can't see if that property was sold, exchanged, gifted, or any of those items. And the document itself is attached to the back of the deed, and that's really only for the eyes of the county assessor's office. It's not there for the rest of the world to see what the components or terms of that transaction was for.
Is there a waiting period between the transfer? You know, once you buy an LLC and move it to a trust, is there some period of time?
That might be a question for Sensei.
No, there's not a period of time. It's really the time of recordation on that trust. I mean, you've got, here's what you got. Let's say, for instance, you own a property in ABC LLC, and it's your LLC, and now you're going to move into a land trust. Well, that only comprises of three things. You got to draft up a PICO, which is a preliminary change of ownership, and you got to draft up a new deed granting the property over to the trust, and then you got to draft up the trust. But the PICO and the deed are the things that go to the county recorder's office and get recorded. Once it's recorded, it's done. Okay, so it can be done today. No worries. You got to remember that it's not a tax-bearing entity. It's not unless you do some sort of sale and you don't transfer that of the land trust. So you're not getting a tax ID for it. You're not filing a tax return for the trust. All that runs through your LLC still.
Right. And there is no consideration for that transfer. So again, there's no taxable event where you're going to be hit with a tax bill at the end of the year on that type of transfer.
It's a beautiful instrument to use. I mean, we use them all the time. But here's the thing, you know, I get this all the time, and I mentioned this last night, and I'm glad you brought, I'm sorry, what's your name?
Oh,
Tony. Yeah, I'm glad you brought that up because it triggers something in my mind. I get a lot of CPAs or tax advisors or EAs, and I get a lot of other real estate investors, especially more the old-time real estate investors that I thought were actually cuckoo back in the day, where they were saying, you know, my granddad always paid cash for all this stuff, and I'm all about leverage, and the next thing you know, we crash in the market, and those guys are laughing all the way to the bank, right? So, but here's the thing, they don't believe in land trusts, and they said, well, why don't you just get a good insurance policy and get an umbrella policy? That should take care of everything, right? Does it?
Unfortunately, not always. And so insurance companies will always look at their exposure when there is a claim. They look, first of all, you know, how can they deny that claim or be exempt from that claim. And so often you see things like asbestos or toxic mold or lead-based paint, and those situations are always going to pop up when you're buying properties that were built in the 40s, 50s, and 60s. And so if there is a claim, often the insurance company will deny the loss there. Other times you'll see intentional torts being committed on a property. We had a case a few years ago where a client owned a apartment building, and a plumber was on site doing some maintenance work, and a guest of one of the tenants actually got in a gun battle and shot and killed that plumber. And so guess what? The landowner, you know, was served with a wrongful death lawsuit. You know, serious case, I mean, multi-million-dollar case. And so they had no coverage there on that particular case with the insurance. So I'm not saying don't get insurance, don't get the umbrella. You want to have as many options and lines of defenses in there to protect you. But again, what the asset protection plan is to protect against that one catastrophic event that you could never plan for, nor could you have ever stopped from happening.
Right. And usually you got to remember, tax advisors are really looking only from one risk factor, and that's the